Hi, everyone, and welcome to the next episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan. On today's show, I wanted to talk to you about the 5 silent killers of small businesses. Now, the reason they're often silent is because they can hit mature businesses a little bit further down the road. They don't always feel them. You know, if you're one of these businesses that does say 500,000, a million, I'm just picking figures out of thin air, you might have quite a bit of cash coming in your bank. And as most small business owners don't maintain a cash flow forecast, what tends to happen is you don't know till the time comes. It's like, here's your VAT bill, here's your tax bill. Suddenly they can't be paid. And you think, how do we get into this situation when we were doing so well previously, for example? Now, that's the more mature businesses. With startups, it works similar, but it just happens quicker. And I want to talk about these 5 mistakes because they're so common, and some of them you're going to think, well, that's pretty obvious. But if it was that obvious, people wouldn't continually do it. So I want to talk to you about all these kind of things. So let's get on with it. So the first silent killer, or not so silent killer probably, is the fact that poor marketing and sales can affect the business in such a way that it ends up crashing. Now, again, this can happen quickly or it can happen a bit further down the line. So as you imagine, as business accountants, we deal with everybody from startup right up to mature businesses. Some people have had great journeys with us and then exited, and some are just starting out that journey and need our assistance. And of course, we've seen business failures. I mean, you probably know the stats. Only about half of businesses ever make it to the 5-year point. Now, our kind of internal stats say that's far, far better success rate if they've gone through the right kind of financial setup. But that aside, the success rate is not good. Now, what we see, let's take the smallest of those businesses. You know, let's take the one-person consultant. So we deal with loads of those. It could be L&D, HR, law. Law's quite a big one at the moment. I think a lot of people are exiting the legal profession into kind of a self-employed / freelance / limited company deal, and anything in those professional service world, engineers. Just think of those kind of businesses. What tends to happen is they start with a project in mind quite frequently. Let's say they're mid-30s, they've exited a job and a career they've had to go set up this thing. And then quite often they might contract back to the business they've left as one of their primary first customers. And that's fine. So they're okay. They're like, okay, cool, I've got projects on the go. And then in about 3 months' time, they're suddenly like, oh, I've got no work. What's happened? And what tends to happen is they didn't do any marketing or sales while they were busy. So it was just one of those things where it's like, I've not got time. I'm really, really busy. And then suddenly there's no more work. Weirdly, the best time we see to do it is to do marketing and sales when you're the most busiest. So you can start lining it up and having that consistent sort of strategic approach to it. Now that sounds a bit weird, I think, strategic approach, but it can be as simple as making sure you attend networking dues or making sure you're posting regularly on social media or whatever the kind of tactic is. It's carrying on doing it while you're busy. So that is quite important regardless of where you are, I think, whether you're mature or whether you're not. But the reason it kind of creeps up on you is because you can have work before this actually happens. And obviously sales and marketing generally can kill the business if it's poor, because new customers coming in, you're out of cash, you're out of business. Going out of business is not any more complicated than that. You just run out of money and that's it. But as we said, it can silently kill you, particularly if you've already got cash. So I think that, doing sales and marketing and being aware of the sales cycle. So we see so many startup businesses that think, okay, I'm going to go and drop down a load of money on paid ads, or I'm going to drop a load of money on SEO. Don't get me started on that, but SEO, right? Or I'm going to go and pay for some leads, whatever the case may be. Paying for leads is probably a little bit different because in theory that should return money a bit quicker. But even if you have the leads and you have a phone number, you can pick up the phone, you can phone and talk about your business, or you've got warm traffic, people coming to you, talking to you about it. They've got to make a decision. You've got to pitch them. They've got to be comfy with what you're doing. They might need proof. They might need time to think about it. They might not be ready to buy because of external sort of circumstances that are outside your control. And the sales cycle, so from when they start and see you first thing on that paid ad you've just made on Facebook, or that first phone call you've had for the warm lead, then what's the time till the money hits your bank? And that's the bit where startups particularly get caught out, is they fail to appreciate how long that sales cycle is. So I think that mistake is key. And again, what we can do about that really is planning appropriately. You can look in your own sales cycle and say, how can I advance cash? Maybe there are ways to get cash earlier, maybe with the way you structure the deals, or you price all your packages, something like that, to get more cash up front. I think what we see is that if your business model can collect a lot of cash up front, it can really be in like a powerful position to grow. I think if you're looking to grow, you need cash, and anybody that can collect a lot of money up front tends to do quite well with that. So, but marketing consistency is really, really important. Doing it while you're still busy is going to be important. So have a real think on what you're doing with there, but plan that initial cash for the sales cycle. That's going to be a big one. So that one's kind of obvious, I suppose, but the underlying reasons may not be. Now, mistake number 2, and this is the most common one by a mile for small business failures that we see, and that's that ultimately the owner draws too much money. So what's too much? That's always the argument, because the business owner will say, well, look, I need to live. And it's like, okay, you do need to live. I need to live. Everybody needs to live. But as a business owner, the only person that can be in charge of whether you can draw that money is you. The only person influencing those profits is you. It's the game we play. It's the fun, I think, is how can you make all this work? But it's the biggest killer in the slightly mature business. If you imagine if you're small, you haven't got the cash to take most probably, so it doesn't kill you that much. But even in the smallest businesses, the amount of people that I've seen that have got into trouble because they've taken all the tax money. So limited companies are a prime example of this. You got a load of tax money in the company, you've drawn all the money, it can't pay its tax bill. You end up with a further tax bill because you've got what's known as a loan account. Gets a bit technical. We've done other podcasts on it. But you can get yourself into like this circular problem where you just keep going around and around in circles. So that one is going to be quite a problem with drawing too much money. And of course, you can think, well, okay, how can I deal with that? And one of the exercises you can actually do, this is where accounting software becomes really important. And, if you've listened to me for any amount of time on any of the podcasts or the social media channels, I talk a lot about my belief that cloud accounting software is where we want to be in 2025 as we're recording this. Something like Xero with an X would be my go-to for various different reasons. QuickBooks is pretty good as well. There's a few of them out there. We use about 4 with the different the 4 that the clients can use, and Xero's the most popular by a mile. But if you have that, what you'll be able to do is you'll be able to pull up a profit and loss report. Now, you might keep your own spreadsheet that has a profit and loss report. It's just a kind of posh word for income and expenditure. And what you can do is you can go through that and you can have a look and you can say, okay, what is the bottom figure of that report? What is my profit on paper? Pick a month where the bookkeeping's up to date, go straight to the bottom and look at that and say, okay, that's what the profit is. Now, that profit, out of that, then take off some other things like if you're paying any loans back, put that on there. If you bought any equipment, put it on there, because normally things like repayments of loan, old tax debt, big equipment you've bought, they're sitting on another report called the balance sheet that you might come across. They're not in the profit and loss, so you're kind of putting them back in. And it gives you a rough sort of true profit figure there. And I use true loosely because there are certain types of businesses with this exercise that figure will be wildly inaccurate. And there'll be accountants now screaming at me going, oh, no, actually, you've forgotten prepayments and accruals. And look, if you want a proper profit figure, you're going to have to probably go and get management accounts or learn how to do that. Most people, I've never come across anybody that really knows how to do that. They just pay an accountant or somebody to do it. But if you want real proper timed accounts to do that calculation properly, that's what you do. But you'll be ahead of 99% of small business owners if you just did this one exercise on these rough figures. And it'll give you roughly a ballpark. Now, if you're drawing more than that figure comes out at, you have a problem. And you've got to have a look at it. The big caveat, just to say with this exercise, is if you have a lot of unsold stock, that can skew the report. But I find if you're in one of those businesses where you do things like you invoice up front and then all the costs come later, or you have all the costs now and invoice later, and maybe that's not reflected in your software, you can either kind of adjust for it roughly if you know what that is, or if you take that profit and loss report and put it over maybe like a year if you've got a year's worth of data, often it averages out. So again, just use averages. You want to get an idea of like the model. I find particularly accountants, actually weirdly, traditional accountants get really hung up on the figures, but you should be able to do it as a model or with averages on like a fag pack. It's an out-of-date term now, but on a bit of paper, like really, really quite easily. So having a look at that and figuring out, okay, where am I? Is that money enough? And if not, we need to figure out how we're going to do it. But if you do have, as I say, sort of work in progress, as it's known, like this weird disparity between when you're invoicing and when you're buying the stuff, or you've got a lot of unsold stock that might not be accounted for, that is 2 big things where those figures are going to be a problem. And if you think about it, picture rates. If you get your rates bill once a year as a small business with like a shop, if you looked at your profit and loss report and your rates bill is on there, that 1 month's going to make it look like you've lost loads of money, but of course you haven't. It's 12 months worth, but that 12 months isn't spread over the different months in your software unless somebody manually goes in and does that. And that's what management accounts do. They spread it all out. So bear that in mind. But yeah, that's the exercise you would do to make sure that you're just drawing not too much money. And then you're going to have to adjust. Either figure out how you're going to make some more profits. We've done loads of different podcasts and thoughts on that, or don't take as much. That one's harder to kind of swallow, I think, particularly as I'm sure you work hard and feel you work hard. Now, mistake 3 is making bad decisions with money. And this is really sad. And this is more, I suppose, one of the more obvious ones. You think, well, obviously, if you waste money, I'm not talking about doing really silly things with it, like going out into the street and just spraying it across the street. I'm talking about things like, this happened, this is a real story. Client, new business, had a really cool concept, spent a personal loan, borrowed 2 lots of 25 grand, put into the business. He spent 25 grand sponsoring an industry event. The industry event, as a headline sponsor, it generated 0 leads, or at least 0 sales, just didn't do anything. So 25 grand done. That was like first month, say. The other thing was that we had a 15 grand spend on a website. Website looks amazing, still looks amazing to this day. I'm actually jealous of the website, actually. But the company's about to be struck off because it's not trading, it's got no money. So beautiful website, beautiful trade names, beautiful everything, just doesn't generate any money. So we had that. I think he also spent about 6 grand on SEO, like search engine optimization. Again, don't get me started on that one, but it didn't do anything for him. Weirdly, the more traditional methods of shaking hands, networking, outreach, cold calling did generate money for the business, but he needed time. The cycle he was selling into, and I don't want to give the business away, but it was selling into public services. So that he's trying to get through kind of procurement and get somebody to sign off that's not that bothered about what they're doing and everything else. It takes ages. But he had a really good potential business. Loved the brand, loved the product, thought it was brilliant. And I think the prospects loved it, but obviously just ran out of money. But if he'd had that money, he wouldn't have had all those repayments to have. And it's just, so I think if you're going to do that, just make sure you find somebody who's been in business a while and just have a chat with them, just get a sense check. Actually, sometimes it doesn't even need to be a person who's been in business, just somebody to ask those tough questions like, what happens if it doesn't generate the sales? Because thinking of their sales, it was something like they're only making about 10 to 20% each sale. It was a very low, what's known as a margin business. So for every £100 that came in, we might only make £10 to £20. It's not a lot. So you need to sell a lot to repay what at the time was about £450 a month for repayment. And you've still got your overheads, your accountant, all that kind of stuff. So have a look and just think, okay, what can we do? And then, of course, there's other things that go on in there. Now, there are things like we live out the bank account, so we think it's okay to commit to things. So, for example, people will sign up to a big unit or they take on a member of their team without really realizing what the long-term implication of doing that is, because they look at the bank balance and say, well, yeah, like I reckon, so say the rent's 30 grand, they look at the bank account and think, well, I got 40 grand. So even if I spent the whole year's money, I'd still be all right. But what they're not picturing is maybe there's a corporation tax bill or a VAT bill or some other bill that they haven't paid yet. Now, the bills tend to be kind of known as the tax ones. I think that if they haven't got the right relationship with an accountant where they can get this kind of stuff regularly, it happens quite frequently. So yeah, they just don't look at them when they live out the bank account. They don't know what money they're really making. And then how can they make any decisions without knowing how much money they're really making? So again, you can do a similar exercise with that profit and loss account and just look at it and just look at what really have you got available. It helps to kind of determine free cash. That's another term you might hear. But the purists will hate me for saying this because they'll be like, well, actually, you've got to include X, Y, and Z. But again, we're talking about like real basics. Just look at that and try and work out. If you had to explain it to, I don't know, your 12-year-old, say, how would you explain it to them? You'd list what you got coming in, what you got coming out every month, and roughly what's here. You take off some for tax. You'd ignore VAT if that's you. You'd do all that, and then you'd work it out. So do that kind of simple exercise and have a look. Obviously, if you need support, there are good accountants that will help you with this. But at the core model, that you should be able to do, again, that business model and that calculation to know whether you could commit to expenditure on paper. But if you're going to do these big things like these big sponsorships, or what is pretty risky, something like a sponsorship, I think is, from what we see, is quite a risky affair. You've got to plan how much cash could you effectively afford to waste. And if the answer is it's terminal for the business, probably don't want to do it. So just bear those in mind. Now, the fourth mistake, and this is particularly relevant in a mature business, is what's known, we call it margin creep. So I don't know if you've ever seen Minecraft, the game. There's these little creepers that walk around and then kind of like they make a weird noise and they explode on you and blow up your beautiful building that you've spent years making. And I find that margin creep, it does this to your business. You spent years making this thing, maybe it makes money, and then suddenly, boom, out of nowhere, you half your business is blown up, you've got no money, and it's all falling down around you, and you're thinking, what's happening? Can't pay my bills, can't pay my tax bill. And quite frequently it's margin creep, and it happens over time. And as we're recording this in 2025, it's very common. So what will happen is, if you pull up two periods, so let's say you had 2023 and 2024, and you've been in business a few years, you'll probably see that things have gone up, right? It's kind of obvious. This year, your O2 phone bill, there are other phones available, but your O2 phone bill will have gone up. You get an email every year telling you it's gone up based on RPI or CPI or whatever calculation they want to use. And that's happened across your business in multiple levels. Then ask yourself, did you change the pricing? And the chances are you didn't. Most small businesses just don't change their prices year on year, or they might for a few products, but not overall. And this margin creep gets you, because what happens is, let's just say you're making, go back to margins, let's say you're making, for every £100 that comes in the business, you've calculated it as a percentage, and you worked out you're making £40 for every 100 that comes in. But that £40 just shrinks over time because all your costs go up and your price doesn't move. And actually, sometimes as you get a bigger business, sometimes even your efficiency doesn't help. You actually get less efficient. So maybe you're only making 35 anyway, and then these costs eat it. And then again, you've probably, if you're mature, you've got a bit of cash coming, and it will just hit you. It'll hit you like there's this explosion. You'll suddenly be like, I don't understand why I haven't got any money. And it will be partly because of a combination of these things, but margin creep is a very real dangerous thing. And you should protect against it as much as you can. There's always this idea, I think, that accountants are here to kind of tell you, oh, you should save money here and here and here. But actually, in our business, we spend actually a little time talking about overheads and cost reduction, more time talking about the model and how you make more at the top end. And the reason for this being is that if you've ever tried to cut your home expenditure, you can only cut so much before you can't live. And business is very much like that. You need things to operate, and it's just not worth doing without, or you can't do the service you want without. But you definitely can control how your product is packaged, or how it's positioned, or the price it sells at. Like, there's a lot of things you can do to fix the top end before worrying about the bottom end. But anyway, you should, of course, review these margins, because some stuff we all know for our car insurance, if you just leave it, they're going to charge you. I recall just this week I was explaining this concept to somebody because I could show them. I had a renewal through for my insurance, and I can't be bothered, because my time's important and it costs money for me to do it, to keep hopping every year. I know that costs me money, but what I do know is, yes, Admiral, I know you can go into the back end and say you're going to leave, and there's now an online button that says, how much did you get for the other quote? And you tell them what other quote that they got, and it goes, oh yeah, cool, we'll just do your deal. Here's your money off, just because you pressed a button. So those kind of margin kind of creep things where you can just review them easily and quickly, and it's really quick to fix and keep those things down, are obviously is an important thing. But I think just being aware that the creep's happening, most of the time you're going to react at the top end. You're going to see, can we be more efficient, or do we need to change our packaging and our pricing to live up with it? So just review it regularly, at least annually. I think if you have an accountant doing your set of accounts, it's cool to look at the two together and say, well, what's happened? And of course, expenditure is not kind of linear. So it's not like you spent 10 grand this year and you're on that thing. Like you spent 10 grand on software last year, you're going to spend 10 grand on exactly the same software, because you've probably added some subscriptions, that kind of stuff, but you can at least get an idea of what's happening. And I think the biggest one to look at, and I think we've done other shows on this, is what's known as your gross profit margin. So it's your sales less the costs to directly deliver that service. So if you sell a widget or you sell a chair, it's the materials of the wood that's gone into the chair, the glue, the delivery of the chair. Maybe you've paid somebody to make the chair. It's that. What's left is what's known as your gross profit. So not your rent, not your accountant, not your sales, nothing like that. Marketing costs, none of that. This is the bit at the top. That gross margin, you want to keep an eye on like a hawk. And if you go back a podcast, I talk about how a client turned their business around by looking at that. But protect that like it's the only thing that matters, because ultimately it is the only thing that matters. It's not the only thing that matters. I'm joking. That's a bit of an overkill, but I feel like that. I feel that passionate about it. I want a t-shirt that says, save my GPM. I don't know, there must be a cooler phrase. I'll have to figure it out. But, a GPM, gross profit margin, we want to protect that like it's your little baby. So keep an eye on that. So that's margin creep. That is a killer, particularly of mature businesses. And then the fifth one, and this is time to now, come closer and we'll have a hard chat. I've got tissues here. We have tissues in our, you can't see it if you're watching this on YouTube, but I have a box of tissues. We have tissues in all our meeting rooms, because being an owner can be really, really hard. And sometimes, although we do most of our meetings these days on Teams because of clients are nowhere near us, when we do get them in person, sometimes you do need that box of tissues. And the one killer is because it's tough and people just lose the love for it. The amount of people, particularly over the last 3 years, that have owners that have said, I want to jack it in, I want to sell, I want to get out, I've had enough. And they've got amazing businesses. I've spoken to clients that literally make millions and have gone, I'm done, I want to exit. And then we're talking about how to maximize the value of that exit, how you might tax efficiently plan that exit, those kind of things. But it's a sad state of affairs, and it's because they've lost the love with it. So I think that what I look at with it is when someone's lost the love, of all these stories, I reckon there's actually only a small percentage that ever do jack it in. Some do, they genuinely do, and they're generally time to call it a day. Some do because they're running out of money and lost the love. And if you're running out of money and it's really hard, and you look at it and think, I could just be employed and enjoy my 5.6 weeks holiday and not worry, and I can see the benefit of that, then fine. That happens. And that's fine. But most of the time, people just need to get like kind of energized again with the business. Remember why they loved it in the first place. But there could be tough action to take. Maybe you've grown to a size where you're surrounded by people ultimately you don't like. They're not good for your culture. You've got constant problems every day. Adding people to the mix has been a problem. That's a very common problem that we see as owners. And sometimes you've just had stuff going on in your personal life and you're a bit fed up with it and you need to get re-energized. So I love the kind of things like, can you get around somebody or around a group of people that are also excited about their business? Can you go to industry events where you can see the magic of the industry again? Like there's lots of things you can do to kind of get yourself pumped back up to do it. And I love that when clients turn it around. I always joke when a client comes to me and says they want to sell their business, I said, let's make a bet. Let's make a bet about whether you will be one of the few people that actually go through with this, or whether this conversation is going to jack you up to go back and pump you up to go back to your job and do better. And in the last few years, although these conversations have been a lot of them, and a record numbers have sold and have exited, still the same kind of thing happens where the majority of people will look at it and just go, okay, I'm going to stay. And actually, I've looked at it and it's not worth it. Particularly if you start talking about value and you're like, well, actually, the market tells us that you're probably likely to get this when you sell it. And they're like, but I'm making, you're going to get X, but I'm making Y per year. So if I actually loved my business and changed it, I'd be better off with Y. And actually that happens quite a lot. And sometimes it's just having a clear pathway. And that's one of the things that we help clients with when they have certain services from us, where we'll meet with them regularly and help them have the action plan. But it's the idea that taking them through that, okay, what needs to change to refine that love? So I think that focusing on that sometimes it's monetary. Someone's just fed up. They want to make more money. Well, look, we can focus on the numbers. The numbers, weirdly, is the easy thing to fix. But sometimes the numbers is the thing that gives somebody the motivation to go and do it. They want to make X profit. They want to do something else. So, if it is getting difficult, then just think about those things. What can you do? And the other thing I think that's quite common is people will want to go start something new. So they've grown to a certain point and they're like, okay, I can just forget it now. I know the skills to reproduce this thing. Maybe I'll go do something else and grow a company to the same bit, but they never reach the next level. And it's pushing through those pain points and realizing that, you've got to learn new skills to get to the new part. And sometimes people just don't want to do it. So, and I think that we see underlying signs of this happening before they do. Sometimes you'll notice that their margins have dipped. What's happened is there's not always figures. Sometimes the margins have dipped. Sometimes sales are slowly declining, or we follow them on social media and you realize they're not really posting a lot when they used to, that kind of stuff. But then sometimes you see it in other metrics. So you'll see things like their churn. So their teams churn. People will leave more frequently. What else might happen? You just I don't know, you just see a lot of other things, like culturally it doesn't seem like everything's tuned in, or something that you saw somebody doing before is now not happening. And there's a lot of markers that show this kind of thing's happening. And when you get the owner on a one-on-one conversation and you really talk to them, that's quite often the case. They're just not feeling it. So for me, the action points would be getting around others that are doing bigger things than you. Talking to people who've been through the same things, always a good one, more like mentors rather than coaches necessarily. Getting out in the world to inspire you generally. I think walking around, I always find walking around London quite inspiring because there's money everywhere and you're just like, how do these people build these massive businesses? It's just cool. Everything. But I also get quite excited by walking around the local market and seeing all the startup businesses and the commerce. I love that kind of thing. So getting out in the world, I think generally is quite good. And listening and watching and filling yourself with positive business content. Obviously, we like to think this is a positive podcast, but we're not, it's not normally a motivational podcast, but there are plenty of them out there where you can listen these days to any sort of podcast. And but I think what you put in your ears is really, really important for this. And of course, the old adage of who you surround yourself with. And it's really important if you've got a team. finding the people that actually kind of light you up and you love being around every day. Because if you then hate them, then you're just making the problem worse, aren't you? We quite call them, dementors. I don't know if you're Harry Potter fans, but it's like having dementors around you is never going to be a good idea for the business. So if you've got any dementors, get rid of them quite quickly. So that would be the fifth reason. But it is very personal. It is very personal. And we aren't robots, so we're going to fluctuate. Sometimes we're going to love it. Sometimes we want to put more effort and we desire it more than other times. And I think that's completely fine. But if you're on this downward trend constantly, you got to think about what you want to do. And you'll notice it, or other people around you'll notice it. So, but often just getting back to kind of what you're doing and finding that love can really re-energize you for and pick the business back up. The cool thing about small business particularly is you can pivot. You can do things very quickly most of the time that bigger businesses can't. And yeah, it's great. So as I said, if you want to hear a story of how a business owner was in this position and sorted out these things, just go back an episode and we talk about that. So that's the kind of 5 silent killers. If you've had any of these, I'd love to hear your experiences, actually. We are currently lobbing these up on my side YouTube channel, I guess. So we've got the business one that at Heelan Associates. We've got loads of, tens of thousands of subscribers on there. We've got 400 odd videos of all how-to guides and big long-form content. But we've also got the HeelanHub podcast that you're listening to now, and you can come on. So hello if you're watching on here. And what's cool about that is you can comment, and we do read them and pick them up weekly. So if you have experienced this and you've got any of your own kind of experiences, put them in there. I love to read them, and it's a cool way to interact. So do that. And also while you're there, of course, like and subscribe. That's what the YouTubers say, right? Now, if you have enjoyed this show, make sure to subscribe generally via your favourite app so you don't miss an episode. We are hoping to return to some interview content as well mixed in with this. We've been working on the tech workflow. It's a bit of a long story, actually. I used to be a podcaster before doing this. For about 10 years, I had a very niche podcast with one of my hobbies, and I used to love doing interviews and had the tech. But when we did this, particularly through COVID, we started the show with interviews and then took them away. But I think we might be bringing some more back into it, so watch out for those. But yeah, anyway, sorry, I got sidetracked there. But yeah, if you do like it, make sure to subscribe via your favourite app. And for more business insight and tax tips, be sure to connect with me and my great team across all the social media channels, including, of course, YouTube, LinkedIn, TikTok, Instagram, Twitter, pretty much anywhere you want. If you are interested in written insight, you can sign up to our HeelanHub Herald, which is a 2-week email straight to your inbox with tips and tactics and these kind of things. And if you go to heelanassociates.co.uk and scroll up and down for a bit, you will get a pop-up there that you can put your details in and go from there. Now, we spoke about the importance of cloud software. If you do want to get yourself some cloud software and get on that journey, heelanassociates.co.uk/Xero, all lowercase, quite important for some reason. You will get a ridiculously good deal with Xero. Helps us, helps you. Everyone wins. So go and check those out. And as I say, and people ask me this all the time. They're like, oh yeah, but you're sponsored by Xero. You're going to say it's great. But I've been a Xero user for some time. My team love it. I love it. And as I've already said through this show, there are other products available if you don't get on with it. But honestly, client feedback tells us it's the most easy one to use and it plugs into most things. So it's good for long-term growth. Check that out. And if you do want to get in touch directly about the podcast, you can just email info@heelanassociates.co.uk and my assistant will get it to me. So it will come. And that's it. So hopefully you have a profitable and tax efficient week, and I'll see you in the next one.